Hello everybody, my name is True Demon and I'm the Devil Stockbroker. Today, we're going to be discussing a heated topic called the Darkpool Problem. For the last year and a half, the retail investment community has been in a heated debate between Wall Street, the SEC, FINRA, and other government regulators about the purpose and the utility of dark pools. And while at one time dark pools were broadly agreed upon that they were extremely useful and necessary to bring liquidity and stability to the market, the retail investment community openly associates dark pools with fraud, pain, and manipulation in the stock market as a vehicle for driving liquidity away from retail investors and away from the buy side of the market in order to push beloved stocks, especially meme stocks, down further as a way of pushing these stocks to an inevitable losing position because only retail investors tend to go long in them. The entire purpose of this video will be to explain what dark pools are and how they were meant to be used versus how they're currently being used. So let's first define what a dark pool actually is. According to Investopedia, dark pools are private exchanges for trading securities that are not accessible by the investing public, also known as dark pools of liquidity. The name of these exchanges is a reference to their complete lack of transparency. Dark pools came about primarily to facilitate block trading by institutional investors who did not wish to impact the markets with their large orders and obtain adverse prices for their trades. Dark pools are sometimes cast in an unfavorable light, but they serve a purpose by allowing large trades to proceed without affecting the wider market. However, their lack of transparency makes them vulnerable to potential conflicts of interest by their owners and predatory trading practices by some high-frequency traders. Dark pools came out of the 1980s as a way of supplying the market with deep liquidity so that institutional traders could exchange very large amounts of shares in any given company without causing the entire market exchange price to skyrocket or collapse and create panic. While this was definitely a useful thing so that institutional traders didn't cause massive swings in the market, the way that dark pools are used today is very different. According to the CFA Institute, non-exchange trading has become more popular in the U.S. that it is accounted for approximately 40% of all U.S. stock trades in 2017 compared with an estimated 16% in 2010. The CFA also estimates that dark pools are responsible for 15% of U.S. volume as of 2014. So why did dark pools get created in the first place? Well, once upon a time, specifically back in the olden days before computerized trading, in order for a large institution to make a trade, they would need to actually have somebody, a floor trader, on the floor of the exchange in what they called the pit. This is the floor of the Chicago Stock Exchange, famously having 3 separate pits where actual trading occurs. The purpose of the pit is for traders to meet for specific types of market equities in order to find a buyer or seller in order to fulfill their orders. The problem with this trading is that this is what it looks like when the exchange is closed and the cleanup is already happening. This is what it looks like during a regular business day. So trying to find another member of an institution that was trying to buy or sell the exact equity that you wanted is literally like trying to scream into the void, this din of literally thousands of people all trying to do the same thing that you're doing. Traditionally, this was the only way to get it done. So if you had a particularly large order, it was extremely difficult in order to find a buyer of equal size that was willing to make that large of a trade, screaming at each other in the pit. The other option was to call up a broker, somebody else you knew, who might have access to that type of position in order to fill the order, and pass that order directly through them and have their floor traders make the exchange on the exchange floor. Usually, these types of large order trades would take days in order to actually fill, and then even longer to settle because all of those trades had to settle by passing the orders by mail or by a runner down to the floor, from the floor of the exchange over to the settlement bank. All in all, the process was extremely tedious, time consuming, and there was a chance that there would be a major shift in price momentum in between the time when the trade was actually transacted versus when it settled. The other option was to split the order up into multiple pieces in order to find different buyers or different sellers in order to complete the exchange. But word travels fast on the street, and as soon as one trader understands what you're trying to do, or somebody else catches wind of it, they go and tell somebody else, and then word spreads very quickly about what you're trying to do. And very soon thereafter, there would be massive shifts in the price before you could ever get the order to fill. And because it was impossible to keep your identity as an institution a secret, everybody immediately began to speculate based on other trades and other public information why you would be trying to make such a move. And because these transactions were so large that they would take multiple days, it would give hundreds of other institutions an opportunity to create a counter strategy in order to take advantage of your large trade. And this contributed to massive market volatility, which, as it happens, later contributed to the massive crash that occurred on Black Monday in 1987. I'm of course speaking of this whopping disaster that took place where the SPY or the S&P 500 fell 30% over the course of just 2 trading weeks, the fastest and most pronounced fall that we have ever had in the stock market up until the COVID panic. To this day, the rate of this fall has never been beat. Even during the COVID crash, although we crashed much farther, it took much, much longer, several months. This only took 2 trading weeks. So dark pools, by contrast to this environment of exchange traders constantly throwing names and numbers back and forth, dark pools provide a veil of secrecy for large institutions to transact with each other behind closed doors and also without revealing each other's intentions to each other. And this is beneficial for both parties because neither one actually knows who they're dealing with, why they're dealing with them, or what the move or the intention is behind. As a matter of fact, most of the institutional traders don't even actually know how many other institutional traders they are transacting with in order to fill the order. The only thing that they care about is that their orders are filling, and that's what matters. And the best part is that the settlement happens within 2 trading days according to T2 settlement. So because of that, the shares change hands extremely quickly, the liquidity is present, and they can find a buyer or a seller almost immediately without ever having to worry about the purpose for their trade getting out onto the street. So what types of dark pools are there? There's 3 major types. The primary one is broker-dealer owned dark pools. These are the largest ones that are set up by large broker-dealers, or think of a large bank such as New York Bank of Milan, Bank of America, Morgan Stanley. These dark pools derive their own prices from order flow, so there's an element of price discovery located in these certain dark pools. Examples of these are Credit Suisse Crossfinder, Goldman Sachs Sigma X, Citibank's CitiMarsh, and Morgan Stanley's MS Pool. The second type is agency broker or exchange-owned dark pools. These are dark pools that act as agents, not as principals. As prices are derived from exchanges, such as the midpoint of the National Best Bid and Offer, also known as the NBBO, there is no price discovery. Examples of agency broker dark pools include Instanet, Liquidnet, ITG Posit, and there are other exchange-owned dark pools that are offered up to market participants by BATS Trading and the New York Stock Exchange Euronext. Finally, we have the electronic market maker dark pool. These are dark pools that are offered by independent operators like Getco and Knight, who operate as principals for their own accounts. Like the broker-dealer owned dark pools, their transaction prices are not calculated from the NBBO, so there is price discovery present here. So what is the major difference here? Broker-dealer owned dark pools and electronic market maker dark pools have their own separate market price discovery. There is no NBBO present. Whatever the price that the trader is willing to pass through to is whatever they will likely get filled at, as long as another buyer or a seller is present on the other side of the order willing to fill at that price. With the agency broker or agency-owned dark pools, they are still tracked by the National Best Bid and Offer. So the prevailing market price that is dictated by the exchanges and the National Best Bid and Offer is what the orders are most likely to fill at the agency brokers or the exchange-owned dark pools. The only purpose of these dark pools is to provide the necessary liquidity and secrecy so that the intentions of the institutions are not revealed during the trade. So let's talk about the advantages and disadvantages. Biggest advantage of dark pools is that the market impact is reduced for large orders. This was the main reason why they were created. Dark pools also have lower transaction costs, so it's advantageous for the institutions that do not want to have to pay exchange fees. The other advantage, specifically to large institutions or pension funds or mutual funds, is that very large trades can pass through to orders in order to exit a massive position. In the example that's listed here by Investopedia, they use the example of a well-regarded mutual fund owning 20% of RST stock, and they sell off the entirety of their holdings in the dark pool. So assuming that you had a massive sale of 20% of a company's outstanding shares, that would flash huge warning signs to the market that there's going to be a crash. But in the dark pool, this doesn't happen because the identity and the size of the trade is never actually publicly disclosed. It's only after the fund discloses the sale of their position, usually many days after, that the stock will actually collapse in price. And because of that, everybody who bought within the dark pool got fleeced, and the big institution was able to sell at an extremely advantageous price because they knew that they were selling, but none of the other participants in the dark pool had a clue. The other side of it is that the lack of transparency in dark pools can be both beneficial and negative to all participants. Essentially, everybody that's operating in the dark pool is on equal footing as far as the lack of transparency and the obscurity of the identities of the participants is concerned. This way, there's no preferential treatment. Whoever is able to get the order filled from whoever, they don't really care. The only thing that they care about is that the order is being filled. But there is an extremely negative side to this in that the actual runner of the dark pool has full control of all the data and the identity of the participants. So you can easily speculate a scenario in which a broker-dealer, especially broker-dealers that are in an advantageous position, having very large clients, puts them in a position where front-running a trade is extremely possible. So if a broker-dealer sees an extremely large order coming in from one of their clients through the dark pool, they can take that as a signal that they need to front-run that trade and take advantage of the price move that will follow as a result. So in this former example where we saw a mutual fund that owns 20% of RST stock and sells it off in the dark pool, you may also have, say they made that sale in a broker-dealer's dark pool. That broker-dealer that controls the dark pool is able to see that order, and they have the opportunity, although this is highly illegal, to front-run the trade and sell the stock short or purchase put options on the stock ahead of the trade's execution, and they know what's going on, but no other market participant has a clue. And you might think, well, that can't happen. Absolutely, it can happen. And there's been multiple cases of different firms being caught doing this. In a famous example, FINRA actually gave Citadel Securities a slap on the wrist for trading ahead of its clients. This was found in 2012 to 2014 that the market maker Citadel Securities was trading over-the-counter stocks for its own account while simultaneously delaying their clients' orders for the same shares. Citadel Securities was accused of failing to establish a supervisory process designed to comply with prohibitions against trading ahead of customer orders. The firm agreed to resolve the case without admitting or denying the findings, which is broadly the case for all of these regulators slapping these guys on the wrist. They give a half-hearted "I'm sorry and we take FINRA's concerns seriously" statement, put it out to the public, make a big PR "I'm so sorry we were caught being fraudulent. We promise we won't do it again. We're going to pay this minimal $2 million fine, and then tomorrow we start up the liquidity machine and do it all over again and make our next billion." I could literally go on for days talking about the disciplinary actions that FINRA imposes upon all of the different trading firms that get caught doing this, but that's not the purpose of the video. If you want to go and look at that, you can Google FINRA.org monthly disciplinary actions to go back as far back in time as you can possibly think in order to go and search for all the examples of these different trading firms that were guilty of this type of front running. Or if you want a quick little Google hack, you can do this exact type of advanced Google search and you can actually find the exact files in PDF format for any type of firm that you want. site:/finra.org, disciplinary action in quotes, and then after that put in quotes whatever company it is you're looking for that you think might have disciplinary actions against it. You'll note that Citadel shows up quite frequently, almost as frequently as Susquehanna. So obviously we have some problems with front running. What else is wrong with dark pools? Well, since dark pool trades aren't available to the public, they can be used for predatory practices by high-frequency trading firms, i.e. the algorithmic traders, which use tactics such as pinging, air quotes, dark pools, in order to unearth large hidden orders, and then they engage in front-running or latency arbitrage, which is where they try to pick up shares of a specific type of equity and then sell it back to the larger institution in the dark pool. So they jump between exchanges, picking up shares in one place, selling them in another, and then capturing price difference on small micro orders. usually the people that they're preying on in order to get shares for a better price is retail investors by shoving the price down on the market and hammering the availability of shares in the lit markets, and then filling orders in the dark pools in order to get a better sale. Of course, we have the front running, but we also see that dark pool operators have often used their data against their own clients in order to take advantage of them in order to fill better prices in the lit markets in order to fulfill client orders. So there's a massive conflict of interest with the firms that are actually running these venues in the first place. And according to the Wall Street Journal, securities regulators collected more than $340 million from dark pool operators since 2011 to settle various legal allegations. The problem is that while they're doing this, these guys are making tens of billions of dollars, such that $340 million doesn't even begin to touch the problem. If I had to pay a 3% speeding fine for billions of dollars of winnings, I would never even blink. I wouldn't even have to think about it. Absolutely, I would pay my 3% little bribe in order to keep making billions of dollars. I wouldn't even hesitate, and neither would these firms. The other real problem is that dark pool trade size is actually at record small numbers. The purpose of dark pools was always intended to fill large block trades without moving the market. How they're actually being used is for high frequency traders to get in and out of positions, front run their customers, fleece retail investors, and get liquidity for massive orders so that they can use it in order to supply themselves with shares to push the market price in a specific direction. It's all used for manipulation by algorithms and high frequency trading firms, and especially the market makers and broker dealers who they themselves run dark pools. So while the argument that dark pools are intended to reduce volatility by obscuring large trades, this actually is quite false. Perhaps it does reduce volatility in that the price doesn't jump around as a result of large orders, but the fact is that the dark pools are so easily used for manipulation and the purpose of defrauding people that the dark pools have become a vehicle in order to push prices in a specific desired direction by these high frequency trading firms, because it provides this deep liquidity for them to go and fill orders, to buy orders at lower prices or sell at higher prices while they go into the lit markets and take trades from all of the publicly traded stocks that are coming from retail orders. Simultaneously, you have all of these broker dealers who are using the shares from retail investors, lending them out for short sales, and then reaccumulating their shares that are owed to their customers through dark pool trades. And because of the delays in settlement time, they're able to do this several days after failing to deliver on their obligations because there's really no way to catch them. It's only because of whistleblowers or because of detailed investigations that any of this ever comes to light, and the fines never even come close to touching the actual amount that was made in the trade that would make it more painful for the trading firm to actually do these nefarious things. There's no incentive for them to stop because the fines are never more painful. The cost of getting caught is never more than the revenue that is obtained from executing a fraudulent trade through dark pools. And this also exists in the cryptocurrency market as well, which is even more dangerous because crypto is a highly speculative, highly volatile asset class that is not regulated even in the slightest. And worse, it's got leverage on it that's built off of the US Treasuries market, which has been shown historically over the last several months to be getting weaker and weaker and weaker. And now there's speculation that there's going to be a massive crash or possibly a squeeze in yields for the treasuries market, leading to a massive loss of liquidity in cryptocurrency exchanges, especially in dark pools for cryptocurrency. If this were to happen, it would cause a massive crash in across all assets of the crypto market, as a bunch of different trading firms suddenly got forced liquidated because they found out that they didn't actually have the cash to be trading these highly leveraged crypto assets. The forced liquidation would cause the prices of all these cryptocurrencies to collapse simultaneously, and not only would these firms be wiped out, but they would drag everybody down to hell with them, retail and institutional investors alike. Dark pools are only advantageous for major, massive funds. And the pension funds that are trading on behalf of individual investors, people who are trying to invest in a retirement fund, They, of course, would argue that dark pools are advantageous to the retail investor, but that's actually kind of a two-faced statement. The pension funds are the ones that are benefiting from it, and by extension, their customers benefit from it because the customers ultimately get a better price. But it's because the pension fund is making a decision as a massive institution that they are the ones who are benefiting. So to the statement that the benefits ultimately accrue to retail investors is not really true. Retail investors themselves, the individual investor, are actually the targets. We are the ones who are actually getting fleeced in all of these different trades. And although the people who have their retirements invested in these pension funds may be winning in the end, they're still paying massive fees to these pension funds that aren't necessarily doing the best job that they could be. So let's break this topic down further into its subparts, starting with dark pool liquidity. We've all talked about like the famous statement about the liquidity fairy that came from the CEO of Virtu, who basically stated that the purpose of the market maker was to supply infinite liquidity. They are the liquidity fairy. They do it with dark pools, and because these market makers own their own dark pools, they're able to front run the trades on massive institutional orders in order to create liquidity for the broader public market. And since these market makers, their primary customer is actually retail investors, and that's who they're actually preying on. They can get this liquidity from major institutional block trades. That's like, say that you had one institution that was trying to sell, we'll just say, 1,000,000 shares. The market maker will drive the price in a specific direction in order to lift the market price for their market participants just above, so that they can get retail to start buying at a slightly higher price. And then they're taking the order from their block participant, the big dark pool institution that's trying to sell these shares. The market maker takes those shares at the price they're offering. The market maker goes into the public market or their retail investors. They fill their orders, and then they take a little bit off of the top, and then the order goes public, and the price of the stock collapses. And then the retail investor is like, well, I just got screwed. And now I want to sell my stock because it's going down. So the retail investor sells it. The market maker says, great. And they pass that order to the public exchange, causing the price to collapse even further because now it's putting pressure on the national best bid and offer, pushing the price in the prevailing market even further down. And this allows the market maker to make money through another mechanism called short exempt. Short exempts, which I've talked about many times on my channel, is a short sale that is exempt from the price test of the Securities Exchange Commission regulation show. This implementation essentially allows market makers to be exempt from locating, one, shares to sell short, so they don't need to find a lender to actually borrow a stock to sell short, and two, they don't have to comply with the uptick rule, which is when a stock has been added to the short sale restriction list after being sold down 10% or a 10% loss from the previous day's close, the market maker is able to short during downticks. And this puts further price pressure because the market maker, quote, must provide liquidity, unquote. And this actually creates a dogpiling effect that the short sale restriction rule was meant to prevent. So now what it actually does is it throws a giant big red waving flag in the market maker's face saying, hey, this stock's getting smashed to bits. How about you come down and short me and drive it even further down? And that's exactly what happens through this short exempt mechanism. And you want to know the other screwed up part about it is that once the market maker just makes this share up out of nowhere, because that's exactly what a short exempt is. If you sell a share short without actually locating a lender, you are selling a naked short. The share doesn't exist. And because the market maker is front running retail trading orders, they're front running their dark pool customers, they're front running the market, and they're manipulating the exchange price at the same time. They know they can win. They know they can win these wars. And they wage these psychological wars specifically against retail because they're the biggest source of liquidity in their entire market. And the irony is that the entire regulation show that was meant to prevent this specifically wrote in exemptions just for the market makers and broker dealers so that they would continue being able to defraud retail investors and their institutional customers at the same time. These regulations were written specifically to give them vehicles in order to continue doing the same thing that they've always done. And the purpose of this regulation was just to pay lip service to the idea that they were actually regulating the market and preventing these market makers and broker dealers and these other fraudulent institutions from screwing people over and still at the same time allowing them to do it. And then in the meanwhile, the SEC and FINRA get to come in with their stupid slap on the wrist regulatory fines for front running all of their trades for $1 million here, $2 million there, while the institutions are making $1 billion in comparison. It's all a great big farce. If you want to know more about short exempts and a detailed representation of regulation short, you can look at my short exempts explained video that I'll highlight here. Just click on the link that pops up over my head. So just to wrap up what the advantages and disadvantages of dark pools and their deep liquidity are, is that one, the advantages only apply to the major, massive institutions that are able to gain access to these dark pools. Specifically, whenever they make a massive trade, it has very little impact on the market. One, because the trade is kept secret, their identity is kept secret, the volume of the trade is kept secret, and it doesn't print for 3 hours to the public exchange, by which time, once the trade has been filled, only then does the entire market realize what just happened, all the buyers just got screwed, and the price starts collapsing beneath them because the rug got pulled 3 hours ago and nobody bothered to tell them. Second, better prices. Also, only for the major institutions, because dark pools only have large players as participants. Big orders can be matched by the dark pool operator at prices that are favorable to those big institutions, i.e., better for the big institutions and terrible for the market participants who only have access to either the market makers' available trading price or the exchanges. Third, no transaction fees. And guess what? You may be trading on a commission-free broker, but it's not so free when your information is being used against you in order to front-run your trades and hand it over to a market maker that's able to get it filled at a better price, and then they leave you holding the bag once the price of the stock you just bought starts collapsing out from underneath you, and it actually happened 3 hours in the past and you never knew about it. Disadvantages from the dark pool: off-market prices may be far from the public market. This is true across the board because that's exactly what dark pools were designed to do. It was designed to make large participants able to make massive trades far away from the public market trades so that they can transact it at the market for a better price. So guess who's in the best position to do this? It's always the broker dealer and it's always the market maker, because they know what the prevailing market price is. They know who their customers in the dark pool are. And in the case of the market maker, they know exactly who their retail customers are, and they know what they're willing to trade it at. And on top of that, most of those market makers are trading in options as well, which they know that retail loves to gamble. So they're going to predict this by selling options that are against the move that they know the stock is going to take. They lift the prices and trick retail into thinking, ooh, a big move is coming to the upside because the price of these calls just shot up. So they go and buy these calls. The market maker sells and writes those calls to their customers. And then all of a sudden, the massive sell order in the dark pool gets filled, and then retail gets f***ed again. Inefficiency and abuse. The lack of transparency results in poor execution of the trades as well as front running, which we've already talked about on all of these other different points. But just to make sure that the point was made clear, let's do it again. And finally, the best part of all of this is that no single human is responsible for this, because it's all done by high-frequency trading algorithms, because the algorithms are so much smarter as a result of having access to all of this private secret data that no one else can see except those that own the dark pool. So by participating in the dark pool as an institutional investor, you are providing all of these market makers with the vehicle necessary in order to screw you by making sure that you get filled at a worse price than they do, and you're participating in the screwing of all retail investors because it's their shares that they are going to pass over to you, or your shares that they will send over to retail, just so that they can watch the price collapse and laugh all the way to the fucking bank. Bottom line, dark pools are only advantageous to the large players. It has no benefit to the retail market. This is widely known, but they still preach that it's somehow better for the retail investor because pension funds do okay. I'll be honest with you, I don't give a fuck about how good the pension funds are doing because right now, all the major banks are profiting off of fraud in order to keep this whole gravy chain rolling. And they're doing it on the backs of liquidity provided by retail investors. They are stealing from retail investors every single day. What I want to highlight here is essentially the effect that dark pool liquidity has on the broader market. And I'm going to compare some very specific stocks that I have chosen that have unusual activity around Darkpool. And I also have some, shall we say, control samples that will show us normal market functioning. So over here is Apple, okay? This is Apple's exchange volume chart. In the yellow line, and this is true across all of these charts that you'll see going forward, the yellow line is the price of the actual asset, in this case, Apple. The gray line that you see near the top of every chart almost is the dark pool or off exchange volume. And the green line or the light blue line is the NASDAQ and the New York Stock Exchange volume, respectively. What you will see here on Apple's chart is that NASDAQ and dark pool volume are relatively matched over the long term. This is trading going as far back as 2019, showing that Apple's chart has consistent volume, although dark pool volume was pronouncedly larger after 2020 and going into this year for the stock. But on the whole, NASDAQ stock exchange volume has been reasonably high, at least 25% on average for the duration that the stock has been trading in the last 3 years. If you go over to Microsoft, you'll see something very similar. Dark pool volume is somewhere around between 25 and 40% on average, while NASDAQ stock exchange volume is somewhere between 30 and 45%, with spikes in between. And you'll notice that there's consistent price action that is following in a specific type of trend in both cases for these stocks. From 2020 on through the end of 2021, we were in a bull market and the market moved consistently to the upside. Once we switched to bear market and things got more severe in the economy, it became a downtrend, the market topped, and it's been going down consistently ever since. No major changes in the volume. There's been no crazy volatility spikes or anything of that nature, while volume between the NASDAQ and the dark pool exchanges has been relatively matched. Now we're going to see an example of a stock that gets messed with frequently, and that's Tesla. Tesla is famously known as the most shorted stock in the market, or at least it was for a time between 2018 and 2021. Dark pool volume was consistently higher after 2020 in Tesla during the COVID pandemic, and Tesla actually was trading at much lower prices. It has been split since this happened, but this was at a time when Tesla was trading at less than $100. The stock was shorted severely going into this bull market after we had hit the lows in 2020, and unexpectedly it squeezed. And notice that every time there's been a major market move for Tesla, it coincided with a massive drop in dark pool volume. Prices peaked during a drop in dark pool volume, and it accelerated, price action accelerated during spikes in the NASDAQ's volume. This is important because Tesla was a stock that was being targeted broadly by Wall Street and institutions, and a lot of them got hurt shorting Tesla the entire time. And again, you will notice at times like this in October, right when Tesla was being shorted the most, it pushed fast from a post-split price of $271 all the way to a $411 price point 1 month later during lower than usual dark pool volume in this area as compared to when it was trading in a downtrend just about 6 months prior. Now we're going to look at some real victims of dark pool abuse, starting with GameStop. GameStop is a classic example. Notice how much farther lower the New York Stock Exchange is below the dark pool trading line. Dark pool trades account for more than 40% on average for GameStop's volume by exchange, less than 30% on average for the New York Stock Exchange, and combined across all other exchanges make up less than 5% of average trading volume. what you will see consistently is that GameStop, during periods when the dark pool volume had suddenly dropped massively, was when GameStop's price action went ballistic. Notice this huge drop down in dark pool liquidity. That was when the squeeze got started in January, from the first week of January till January 14th. And GameStop's price post split was trading at $9.50. After this period of going sideways, GameStop also experienced a massive decline in dark pool volume, from a staggering 62% of exchange volume all the way down to less than 35% of trading volume. And during that period, GameStop went crazy, from a post split price of $9.80 all the way to a high of $95. Pre-split, this was a move of between $30 all the way to $400. And this took place over the course of just one trading week. This was the famous squeeze. Dark pool liquidity at this time was at an all-time low, meaning that institutions were scared away and they stayed away from the stock, except for the ones that had no choice but to go to the market. And it's very hard to see here because of all of the crosstalk between the different exchanges. But what you will notice is that the New York Stock Exchange in the light blue colors, as well as the SIBO Edge, that's SIBO EDGX exchange, all of these exchanges spiked in volume simultaneously with this. Now, this correlates to the drop in dark pool volume, but what it shows you is that lit exchanges were being hit with all the volume simultaneously. These exchanges are subject to the national best bid and offer, so price discovery was happening here, and it was forcing traders of institutions to go to the market in order to cover their shorts. GameStop was a famous example. You'll also notice that all-time lows in the dark pool volume also coincided with large rises in the price ever since. Huge lows in the dark pool volume, big price action always happened after that. And this was consistent across the history of GameStop's trading. Let's go take a look at AMC. Again, this is an even more pronounced example because all of the exchange volume was less than 10% on average, ever since about October of 2020. Dark pool volume made up a minimum 50% of trading volume for AMC ever since this date. Really, as far as going as far back as March of 2020, but absolutely after January 2021. Notice that the squeeze that occurred in AMC that coincided with the GameStop squeeze coincided with a massive drop in dark pool volume every single time. There was another squeeze in AMC that occurred a few months later in March and February, also occurred when dark pool liquidity had dropped massively. And again, going into the June squeeze that saw AMC go from a pre-split value of $13 per share to $72 per share, also coincided with dark pool volumes dropping below 50%. Now, AMC has been dropping into these areas multiple times since then, but we haven't seen the same price action. Nevertheless, all exchange volume remains extremely low. What does this tell you? Is that dark pools are providing liquidity to keep the price down low. And when all of the exchange volume is being hit, when all of the trading volume goes to the lit exchanges, it has a direct correlation with price action to the upside. It aids price discovery from the buy side. Now we look at Bed Bath & Beyond. Bed Bath & Beyond also, very similar to Apple and Microsoft, had consistent price action between the exchanges and between dark pools. Up until after March 2022, when the price started to go into massive decline, dark pool exchange volume started rising rapidly while lit exchange volume was declining massively. Except at a time in August of this year when Bed Bath & Beyond suddenly started to squeeze from $6 all the way up to a high of $30. And notice that this coincides with a massive drop in Darkpool liquidity. Again, exchange, especially the lit exchanges of the New York Stock Exchange and the NASDAQ, spiked up while Darkpool liquidity dropped down massively. And then my final example is BBIG, Vinco Ventures Incorporated. Also, Darkpool volume, and this is the most extreme example that I've had so far. BBIG has been trading with Darkpool liquidity in excess of 50% trading volume for the entire duration of this stock's existence. Since its IPO'd, more than 50% of the stock has been traded in the dark pool as opposed to the lit exchanges. However, again, you will notice that every time that the stock started to see positive price action, it coincides with massive drops of dark pool liquidity every single time. Big drops in dark pool liquidity, massive rises in price, and the lit exchange by comparison starts going up in volume. We've been having more and more severe spikes in volume to the lit exchanges recently, with massive drops in dark pool liquidity that coincided with price action to the positive side. And this has been going on since April of this year. Now, we are trading in a bear market, which is very disadvantageous to squeezes. However, there are still situations where if a stock is able to get that runway where lit exchange volume is rising and the positive price action is happening while short sellers are having trouble finding liquidity in the dark pool to fill their orders, this can cause runaway effect and short squeezes can happen in these environments. At this moment in time, BBIG's dark pool volume is on this ascending trajectory, but it is capping out at around 70 to 80% of total volume. But what I'm pointing out is that 80% of volume for a single stock, especially a mid-cap stock, to be trading 80% of its volume in dark pools exclusively is not normal. It's not normal. And BBIG is primarily traded by retail investors. We know this by comparing volume from FINRA, showing that retail investors, or rather Fintel shows that retail investors are by majority the largest holders of BBIG stock. So if retail participants, who we know do not have access to dark pools, are the majority holders of BBIG stock, why is it that 80% of the trading volume that is occurring in BBIG is consistently happening in the dark pools, while the lit exchanges are seeing less than 10% combined across the entire market? This is exactly the problem that we have with our markets. Everything is so opaque and it's so obvious to anybody who just dares to go and peek underneath the hood to see that the entire engine is on fire, while the SEC, who is supposed to be the enforcer of our regulations and making sure that the bad actors are behaving themselves, are going behind us and just saying, whispering into our ear, telling us everything's fine, we have it all under control. There's nothing bad happening here. Don't look behind the curtain. And anytime we try, we get swatted and pushed away and told to shut up and stay in our lane. And by the way, those of you that like to trade crypto and say this doesn't apply to me, here's a wake-up call. Guess what? There is dark pools for cryptocurrency, and you're also getting fleeced there too because all the exchanges that you use are hooked into them, okay? Crypto dark pools are just the same, and even if you look at LCX's website, they'll try to sell you the same spin that traders who use the dark pool have a huge advantage of being able to have their massive trades broken up into smaller orders and spread out across all the different exchanges, giving access to deep liquidity. Guess what? This is where high frequency traders live. And this is the reason why Bitcoin, Ethereum, Cardano, Trezor, ETH token, you could just name any one of them. It doesn't matter. They're all subject to the same levels of fraud. The purpose of the dark pool is not to make things advantageous for everybody. The purpose of the dark pool is to make sure that everyone gets their fills. And in order to get everyone their fills, they have to keep everything in the dark and keep it all secret so that no one else knows what's going on. But the problem is that this is only advantageous to the big players who have access to large amounts of money, crypto, and assets. Just as with standard dark pools, if the trade facilitation institution has a conflict of interest, it has the power to disguise actual market prices and front run your orders. If most trade takes place in the dark pools, then public exchanges prices will not accurately reflect the market, and a big part of investing and trading relies on the open flow of information, which dark pools directly conflict with. High-frequency traders can find that dark pools are an attractive environment for exploitative practices. They can front-run massive orders and take advantage of naive traders if they have exclusive access to the order book data, i.e., the facilitators and the owners of the dark pool. Dark pool average trade sizes have declined dramatically since their debut in 1980s. This makes their existence far less appealing and may even be harmful to the market overall because the order sizes have declined. We are seeing that high-frequency traders are the largest participants in dark pools, such to the point that even large institutions are being targeted by the high-frequency trading institutions that are able to front-run all the orders, especially the dark pool facilitators. And yet, despite all of this, you will find that dark pools are the prevailing standard of all exchange trading occurring across all asset classes in the market. That is because all of the money is consolidating to just a few players, the biggest ones, the 0.001%. And if you're naive to think that just because you invest in Bitcoin or Ethereum or you're going to have this utopic decentralized currency, think again, because all of it is being accumulated to one place, just the few players that are sitting at the top. The 1,000 most wealthy individuals of the entire world are the ones who are trying to pull all of this money into one place so that it exerts ultimate control over everyone else. And the worst part is that no one is paying attention, nobody else is noticing. And just to illustrate that while the narrative is going to always be that the rich are your friend and that they're only looking for what's best for the entire world, and that's perfectly exhibited in this article from Forbes magazine stating that, oh, they're not so wealthy anymore because they lost a combined $315 billion ever since this bear market started. So they're giving back, right? Well, not really when you consider that they took more than $50 trillion from us just during the span of the COVID pandemic. And this isn't just through estimations of the increase in wealth of the stock market. No, this is directly attributable to the redistribution of income, and not even the top 1%, but the top 0.01%, who have absolutely dwarfed the wealth accumulated by the entire 1% separate. The entire 1% making up just 1.6 million Americans have an average income of $1.3 million, compared to the top 0.01%, which have an average income minimum of $31 million. A purely unfathomable amount of money that is used to exert control and is broadly dominated by their special interest groups, hedge funds, trusts, and of course, the businesses on Wall Street, the investment banks, and the market makers that have accumulated all this wealth and designed the system so that everything goes into the same funnel that leads directly into their pockets. And by the way, this is a dated figure from 2017. The reality has grown by about 4 times as much now. But sadly, if I go and actually search this on Google, there's no figure that's recorded since 2018. We don't actually know the real number anymore because nobody in mainstream media will talk about it. And the figures that were born out of the studies created so much backlash that they were very certain not to let that happen again. And as I've explained in this entire video, it all starts with dark pools. More specifically, it begins with the banks that run them. The system that's been put in place in order to make sure that no matter how the retail participant plays, the deck is always stacked against them, and the chance for them to actually experience any kind of success in the market is all but guaranteed to end in failure. So the question then becomes is what does retail do about it? Well, for starters, I might suggest making the SEC's lives very difficult by making sure that we never shut up and never stay quiet about this problem, because it's a problem that's existed since the dark pool was created, but specifically since it started being abused by high-frequency traders, and nothing has ever been done about it. Knowing that if dark pool liquidity was eliminated from the market and disappeared overnight, that seeing all of these extremely overly shorted and abused stocks would squeeze to the upside, and we would see actual price happening, knowing that this is what is going on and the only benefactors are major institutions that have already stacked so many advantages up for themselves that it's literally impossible for retail investors to win at anything, just smacks of the profound levels of corruption that we have allowed our entire society and economy to descend into. It's the SEC and FINRA's job to do something about it. They've refused to do it for the last 2 decades. Nobody is holding Congress to account, so it's time to start screaming about it and not shutting up. At this point, I think that short of full-blown rioting in the streets, we haven't really tried everything. But in a bid to try and keep things civilized just for a little while longer, I might suggest writing to the chairman of the SEC, to the regulators, begging them to actually do something. Not just tweeting about it on Twitter, not just complaining on the Reddit boards, not just reposting something that someone else said on Facebook. No, by actually writing letters, harassing them with emails, and constantly communicating the rage in mass of what we feel is being all of this fraud that we are being taken advantage of every day by, and never letting the SEC forget who they're actually supposed to be serving. The other thing that you can do in real time to actually make a difference, stop buying from market makers. Stop using zero commission brokers. Don't use Robinhood or Webull or any broker that doesn't allow you to direct your orders directly to the exchanges. The final thing that you can do, and I understand that this is a controversial topic, but I am going to put it forward to you anyway, is DRSing. Direct registration of shares does actually have a correlation with the upward price action because it reduces liquidity to dark pools. This is because by direct registering your shares, you are handing your shares over to a settlement firm that will register the shares in your name, which is the equivalent of putting your name on the stock certificate and storing it in their vault in your name. This is the only way to ensure that your shares cannot be used against you, because when you buy from a standard broker, you do not actually own the shares. They are held digitally against your name, but they are only held in your account. They are able to be used through a daisy chain of liquidity provision, such as, lending for short sale programs and other things like that. As long as that's allowed to happen, brokers are always going to find ways in order to shuffle the shares around and make use of them so that they are always being used against you, the retail investor. That's how the system is designed. That's how it will always work. The only thing that you can do that is actionable is to actually DRS your shares so that they cannot be used by any broker by any means, and they can't be used for arbitrage or short sale lending. And finally, I would highly suggest joining a group of traders that are actually focused on educating its participants. Specifically, my group, Hell's Trading Floor, is committed to the education and empowerment of retail investors by providing resources, access to data, and valuable, actionable trading analysis to provide you with the best possible plays and the best direction for the market on any given day. If you would like to join Hell's Trading Floor, you can do so by joining us at hellstradingfloor.com, where you can click the link to subscribe to join our Discord at discord.gg/hellstradingfloor. If you enjoyed this video, I please would ask that you give the video a like, subscribe for more information like this, and again, please consider joining our group. What's more, please also consider sharing this information by retweeting it on Twitter, sharing it on Facebook, and any other social media platform that you like. The more retail investors that we put this information in the hands of, the more powerful we can be as a unified community, standing against the corruption of Wall Street and the SEC, FINRA, and regulators in Congress. Thank you once again for giving your attention to this video. I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.